Okay, so we will continue with the session. Last week, means last video, it was about 2 hours, and I think we completed quite a few slides and topics. We completed until here market analysis. What I do for the market analysis. I didn't explain in detail as to what all things I do because all these things are available in the public domain and you can see. Open interest is yet to cover. I have put in a different slide for that, and market profile. Maybe if you want to learn, you can learn. And how I dissect the news, I have put in a slide separately. And global market behavior, you can see that, and other asset classes, it's all you can track. Chart patterns, probably I added means I will cover as a separate slide, that also. And higher high and higher lows and retracement patterns, that also I have a different slides. So we will continue with the session with the remaining topics. And most importantly, so we have gone through all the basics of the options trading. It is not that, okay, I'm teaching the basics of the markets or anything, but what you need to know while trading options, that is what I cover. And after market analysis, I do have a slide on what moves the market. This is a puzzle for everybody, even for me. But with my experience and observation in the market, this is what I think. There can be difference of opinion on all the things mentioned in this slide, but it is as per me. This is what I believe, and my trades and my market views and market analysis are formed around this view. So it's very important for me. Okay, so I divided market into 3 time frame. Not just me, everybody does that: short term, medium term, and long term. Maybe this time frame differs for most people, but for me, my kind of trading, I consider short term as a few hours to few days. But for a long term investor, short term means it can be few months or few years also can be short term. But for me, for my trading style, it is few hours to few days. And medium term is maybe few days to few months. It can be a year also, or even more also in certain cases. Long term, it is years. And during these time frames, what moves the market? We have short term trend, medium term trend, and long term trend. So short term trend is all about the positions. Positions drive the market. Means long unwinding and short covering. So that is what makes the market move. That is most important to me. Like if there are like lot of longs, excessive longs, then there are chances that the market can come back down and there can be a mean reversion. But if it is the start of the long build up, market can continue to move up. And similarly for the short, if it is the start of the short build up, the market can come down. And if there are like excess short, then the market can give a correction. Give a retracement, short covering. So that is how I analyze the short term move: long unwinding and short covering. So how do I understand there are a lot of longs, or it is the start of the long build up, or it is there are like a lot of shorts and short covering? There is no solid method that you can clearly say, okay, this is how it is. But there are a lot of things that we can follow which can give us a fair idea. So some of the slides that we covered, and some of the slides that we will cover in the future, in the coming hour, those will give us some idea about the positions. And I will link this with that while covering those slides. And the medium terms, it is like few days to few months is a medium term for me. And during the medium term, the market is driven by the liquidity. It's all about the cash flow. If there is enough cash in the market, if there is no liquidity crunch, market is likely to move up. But if there is not enough money in the market, if there is a crunch in the cash, market is likely to correct. The funda is, when you have money, when you have excess savings, you have a lot of money. If you are somebody who tend to invest in the stock market, you keep on investing in the stock market because you have money. So most people, if they have money, they like to put up the money in the market. especially the people who are into the market. But the people who have already invested, if they are facing a liquidity crunch, if they don't have money, there is, instead of taking a loan, most people prefer to liquidate their stocks. So there are times when people sell what they have instead of what they want to sell. Like there are extreme bear market situations, people know that okay, the market is bottoming out and it is the extreme buy, but and they don't want to get rid of the stocks. The problem is those times people will be facing extreme cash crunch. So those times people will be selling what they have, mostly the most liquid items which can be liquidated and taken as a cash as soon as possible, which is like one of them is stocks, FD stocks or whatever. So those times, I think in recent past we haven't seen. I don't know if something really bad happens, it can come in future. So it's a cycle. So we will definitely see in few years time, means or within a decade or something, that kind of situation. That is what happened in 2007-8 also, or 2008 financial crisis. So all in all, what I want to convey is, if there are like enough money in the market, whatever correction happens, it will be short-term correction, and in the medium term, it is likely to reverse, and the market is likely to move up. And that is the reason of late I had put a tweet saying that our market is having a lot of acquisition, because a lot of money was floating around. One example is, if you look at the foreign institutions, for over from April onwards, they had been buying thousands of crores every single day, and maybe a couple of situations they sold a few thousands of crores a couple of days. That's it. Rest all days they've been buying huge chunk of stocks every single day in cash market. So those situations, the money is flowing into the market, excess money. If DIIs or retails are buying, that is the money within India which is circulating in and out. But if foreign money is coming in, that is like an inflow to our country. So those kind of inflow, when those kind of inflow is there, it is very difficult for the market to correct. Any correction will be short lived, and it can come back up, right? So that is my medium term view. Liquidity drives the market. So liquidity, you need to look around and figure out whether there is a liquidity crunch, like people are facing financial issues, and there is a difficulty in getting the loans, or there is no foreign institution money is coming in, and they continuously sell in the cash market. All these are like signs of liquidity crunch. But loans are available everywhere, and people have a lot of money to spend and save. So those are the situations where we have the excess liquidity, which can drive the market up to insane levels. And long term, regardless of liquidity, regardless of position, in long term, the market moves depending on the fundamentals and the quality of the stock. So whatever happens in the market over a couple of years time, no stock can be beaten down uh, against its quality, or no stock can take up and keep up without quality. So this is pretty simple. Long term is pretty simple, medium term is pretty simple, short term it is easy to understand but difficult to figure out whether it is playing out or something. And medium term and long term also, it is okay, most people can decode it and they can understand it, but short term it is very difficult for most people. That is the reason people are depending on open interest and other stuffs to understand the position in the market, to take a proper decision. But the reading of the data can be little different, mostly, and the novice people, they read it differently, they just go with the book rule. Okay, I think this is clear. Probably I will have to touch based on these things while covering the remaining slides. We will move on to the next slide, which is open interest. Like I said, short-term open interest can be one of the reasons. I don't pay too much attention to the open interest, frankly speaking, because that is most widely used things. And back in the days, maybe before 2020, people were not into the option selling. The retailers were not into the option selling. Mostly the option selling was done by the institutions or the HNIs. The people who have a lot of stake in the market, they used to write the options. Those days open interest was very valid, but now every Tom, Dick, and Harry comes into the market and they start selling options. They write options. So I don't think the current crowd who are writing options, they have the power to control the market. Earlier that was not the case. Imagine in 2015, 16, 17, 18 or something, during those times, if open interest is high in one strike price, it can be clearly considered as a resistance. Most of the time, almost every time, that was a resistance, because the people who are writing the options in that strike price, they are like institutions or HNIs. But when the retail crowd came into the option writing arena, they start following wherever the market is moving. Like if the market is falling, they aggressively write the call option. If the market is rising, they aggressively write the put option. So if there is a excess open interest in one strike price, I don't means I consider it as a support. But the problem is, when that level is getting broken, it can be little bad. Let's say 19,500 on an expiry day, market is trading somewhere 19,450, 460 range in Nifty, and 19,500 has enormous amount of open interest. In such case, yes, it is a resistance. So we need to be careful, and I also will be careful. I will not consider it as any trap or anything. But if 19,500 is broken and sustained, we must see a exploding move. And we must have seen that time and again in the market. When these kind of excess open interest levels are broken, market flies. It moves like anything, crazily. So most tenured or most experienced option players know this, and they play accordingly. But what happens with the novice players, the people who are not that experienced in the market, they see that, and even when the level is broken, they keep holding on to the options and written options or whatever positions they have, saying that 19,500 has a extremely high open interest, and that will be tested, means that will be retested, or the market will come back to that. The writers will bring back the market to that level to save their position. No, because the people who have written options in this kind of situations, they are not the powerful people who can control the market. They are like mostly retailers. So that is one thing you need to keep your eye on. It is not that, okay, if there is a strike, that is not a, I'm not saying that it is not the resistance. It is a resistance, but once that is broken and sustained, you need to be careful, because then the move can be unpredictable and it can be extremely big. Okay, so I don't have a live data because it's not a live market. The market is closed and it is a Saturday. I'm recording this, but I can show you this in NSE website. You go to the NSE India website and go to market data, and in market data you can see the option chain here. So go to the option chain, you can select Nifty, Bank Nifty or whatever, and you can select the expiry day or strike price or whatever. So when you come here, Nifty is currently trading at 19,517. And if you come here, right now the open interest is not that great, because these days we see the build up and unwinding of open interest during the intraday. There are like very few positional players. Probably in this case, if you look at 19,500 is 100,000 contracts, that is the open interest, which is in the money. That is very, very critical, very, very crucial. So market closed at 517. If it is an expiry day, and during the market hours, if the market when the market was like trading at 19,450, and if there is like 100,000 open interest and other strikes are having like 20,000, 30,000, if that is the case, yeah, this is a resistance. But the moment it is broken, not just the moment it is broken, if it is broken and if it is continuously sustaining above that level, like 15, 20 or even 30 minutes, then it's a problem, because then the market is not in a mood to come back after testing the level. So in such situation, this kind of difference in open interest, this is not a big open interest considering means during the intraday, but Overnight it is higher open interest, like it is all these like 5,000, 10,000, 20,000, and this is 100,000, right? And this is like 57,000, so it is pretty high compared to other strikes. So such a difference, if there is in one strike, and if it is broken, yes, the move can be big this side. So that's a common thing. You need to just keep a watch on it if that kind of levels are broken. So frankly speaking, that is the only thing I consider or I analyze in the open interest, nothing other than that. Okay. I don't pay too much of attention. I'm not saying that it is not important, it doesn't work and all, but for my method of trading, it doesn't play that much importance. Okay, back into the presentation. We will move on to the next slide, which is patterns. So there aren't many patterns or indicators I follow. I think I covered majority of this during the first session. So you can probably go back and revisit that, or I'll just touch base on it, but I'll not go in detail. So most indicators lagging indicators. Therefore, you will have a large downtrend if you follow the drawdowns if you follow them. Like most of the indicators, it is lagging. Like probably I don't have to explain that, but you yourself will be knowing that when a trade based on the indicator fails, your exit will be little farther, right? And even when the trade works, if you don't scale out, your final exit may be if you get a reversal sign and you exit, most of the time the gain can be vanishing unless you are a positional trader. So that is the reason I don't like to follow any indicator. It is not that it doesn't work, it works. I'm not against indicators, just that I don't follow them in detail. So I always look for the market, how the market is trending, treating each swing high and swing low. This I clearly explained in the last video. So head and shoulder, cup and handle, and the swing high, swing low base patterns. And in a flat market, if the market makes a quick move to one side and suddenly reverse and clear the day high or low in the other side, this move is most likely to continue and the best one to trade. So I think probably I can show a live example for this one, and maybe these items I showed earlier also, but this one I can show a live example, which was a missed trade last day. This is a 3 minute chart of Bank Nifty. This is for the Friday, and this was a trending day on Thursday, and this was another trending day on Wednesday. So this day I was expecting the market to come back because I thought, okay, US was not responding to the US news, so after a huge gap down and first round of correction, we should come back is what I thought, what I was expecting. And I took small amount of put sell somewhere here, and I added calls, maybe I don't remember where exactly, but I think it was somewhere here. I added some call long also, because after a series of downtrend, it was like coming back and started to give some kind of bounce, not meaningful one, but I was expecting this level to hold. And what happened was, it was like swinging, and suddenly there was a reasonable bounce. So from this low, if you look at 45,031 to 45,130. So when the market came here, I was expecting that the market will clear this high and sustain, because I consider this high, market actually cleared this high, and I was expecting this to give a bounce from here, but actually it turned out to be a fake breakout, and it started coming down. The first red candle, when it came here itself, I realized it is going to fall big, but because it was a little fast and furious, so I exited. But the problem with me was, I was supposed to take a short position here, because one round of fall, the market was consolidating, then it gave a bounce and coming back. Because when it gives this kind of fake breakout, what happens is, many people take the long position, many people exit the short position, and they go long, right? But when it breaks out, breaks down, what happens is, the shorts will have to be recreated and the longs will have to be unwinded. So the fall can be little severe. So if you look at here, 45,127, and that fall went to 44,007, maybe 727, we must say. So it was like 400 points fall in one stretch. That is the kind of fall we got after this kind of thing. So this in a market staying flat for some time, then give a bounce to one side and come back to the other side. That is the best trade to take, and I generally like to take that kind of trade, and that will have more mileage. So rather than market staying here, maybe if it is falling here, it will not have this much of mileage. It would have entered far earlier, because the earlier shorts wouldn't have exited and they must be in the system, and longs wouldn't have been created. So this is a beautiful pattern that you can trade. One thing that I want to cover about the chart pattern is for the chart pattern, probably you can go into Google and search about chart pattern and open any of the links and learn about it, because there are a lot of free resources available, or if you go to the YouTube, you get a video explanation about it. So there are two types of chart patterns. One is or probably we can say three types of chart pattern. One is mostly based on the higher highs and higher lows, or lower highs and lower lows, and the second pattern is reversal or continuation pattern. So reversal or continuation pattern, mostly those are like uh, triangles or wedge or flag, or all these things are like continuation or reversal pattern. This head and shoulders and inverted head and shoulders, those are like mostly reversal pattern. Double top double bottom, which is like M or W, those are like reversal pattern. And V-shape recovery and A-shape fall, all these are like a reversal pattern. So these are like pretty simple things to understand. And when you look at the live market also, it is not too difficult to understand means understand in hindsight, but in live market it take long time to get used to it. Like when you come here, frankly speaking, this was like not a reversal pattern, it was like a consolidation. The funda is just this, like market moves in one direction, then it consolidates, most like consolidates near day low, most likely it is tend to fall only. And the market moves up, then if it is consolidating near the day high, most likely it is supposed to go up only. So that is the basic funda. And most of the time when the reversal happens, it will be like this way, like V-shape recovery, W-shape recovery, or this like a inverted head and shoulder, like shoulder, head and shoulder, inverted head and shoulder pattern. All these are like a reversal pattern. But in live market, it's so tricky, but it is very important to understand these things. It will help you in trading and in long run. So chart patterns. So spend some time and learn about the chart patterns if you don't know, because there are different kind of crowds in this session attending, and many of them, I think almost maybe 90% of you may be knowing it, but there will be still 10% of the people who are not aware of it. So that's why I wanted to emphasize on this one. I rely on these things a lot just to understand how the market is shaping up. Retracement tells the story. I think this one also I covered already. Every move will have a reaction or retracement. Instead of going with the Fibo level or any other theory, I look at the price action during the retracement. Flat retracement often results in a continuation of trend, and sharp retracement often results in reversal. You may learn flag triangles, same thing. So what I spoke about, what to say, the patterns, that is what I explained in a different slide. I think this is the best one to explain about the patterns. I'm not recommending this one, I'm just saying that for the purpose of this video, this could be better. See, this one move, then it is a flat reaction and it is a continuation. So these kind of flat reactions or flag and wedge other stuff, these are like continuation pattern, and these kind of sharp ones, these are like mostly reversal one. So learn more about it, you'll get the idea about it. So that's all about the retracement. So the basic idea is understand or spend some time on the chart patterns and try to learn as much as possible, and try to observe the pattern development during the market hours. That will give you some clarity about the market. We will move on to the next slide, which is news, trigger and events. So never trade on headline news. Read and understand the full news before reacting. Need to approach non-expected events and unexpected events differently. And most of the news or events movements are identical if you review closely, even though it looks extremely ironical at the first look. So usual cool off time after the news is 90 to 120 minutes. This is based on my observation. So these are the things that I wanted to share, but I'll explain it. So never trade on headline news. That is very important, because when you look at the news, it could be misleading. So one example, yesterday there was SBA result, and if you look at the SBA result snapshot, the first snapshot came in, it was like extremely good result, because the profit beat estimate. It was like way higher than the estimate. So if you start trading on that headline news, it will be extremely good, and you might tend to take the long position. But if you look at the news in detail, if you go into the result and analyze, their NPA was higher and their net interest income was lower. So that way it was bad. And you don't need much time there. You, instead of glancing only at the snapshot, you can just look at the remaining details too. That will give you a clarity, and that will tell you why the stock is moving down. I'm not saying that okay, if the bad result trigger the sell off and good results trigger the up move. That is not what I'm saying, but that is one example I gave. And similarly, even during the budget or any other announcements, when you look at the headline news, it might give you a picture, but when you read it in detail, it might be different. Some of it look like it is a good news, but when you read it completely, it may be bad news, and other way around too. And make sure that you understand that fact. That is the first thing. And second thing, known and unknown news. Sometimes if good news is expected and good news comes in, the market may fall, because expecting the good news, there are a lot of people who have taken the position. They might want to unwind, and the market might come down. That is why I'm saying positions drive the market in short term. Okay, some of the news which is expected, even though it is a bad news, once the news is released, you can see the relief rally. The reason being, there will be, first of all, there will be shorts created expecting the bad news, and second, there will be a lot of people who will be waiting on the sideline to invest. For example, for the elections or any other bad news which is expected to play out, people will be knowing it is a bad news, so most people tend to wait until the news comes out so that they can peacefully invest. So once the news comes out, even though it is a bad news, they tend to get back into the market, which propels the market higher. So always be mindful about the expected bad news. Most likely it will give you maybe it can give a reaction, immediate reaction on the downside. Then most likely it is tend to go up, unless it is like fundamentally bad or something that is extremely negative, which has a long term impact in the market or economy. So be alert on that. Don't just blindly go on short on the expected bad news. And most of the news events are identical, and the reaction time is about 90 to 120 minutes. So there are a lot of chart I collect on a day-to-day basis, and I update the notes also. And whenever there are the news or triggers or events, I keep a note under the chart. So when I go back and review it, I can clearly understand that this is what is happening. About 190 to 120 minutes it takes for digesting during the intraday. And if it is overnight news, sometimes the first 1 to 2 hours it may chop around. Then after that, it starts giving a trending move. And after this 190 to 120 minutes, the trend can accelerate also. So this is one observation. And when you pay close attention, you will be able to understand that. Here also the positions are important. One example is 2021 budget. So before the budget, before the budget itself, people were so pessimistic about the budget, and the market started falling real big. And people were saying that okay, this budget is going to be bad. There's nothing going to be in the market, and everybody was like bearish on the budget, pessimistic about the budget, and bearish on the market. And the market kept on moving down until the day before budget. And the budget day morning, it was like morning it was chopping around. There was not much trend, but it was not showing much weakness. Every dip was getting bought, and the moment the budget speech was over, the market started shooting up. It was like hell of a rally from I think 29,000. The market reached 32,000. The bank nifty within like budget day and the next day. That is the kind of relief rally that gave after the budget. And frankly speaking, in 2021 budget there was nothing, and people did not expect anything, and there was nothing, and there was nothing positive for the market, but there was nothing negative also. So that is the kind of impact that can happen after the expected news and events. So just monitor, keep a note of it, because if I tell you, okay, this is how it is, this is how it is, no, there are a lot of nuances that you need to figure out. That you can figure out based on the observation. One thing you can do is you can go back to the previous charts and previous event days and analyze it. Before every budget day, I go to the like last about 5 to 10 year. I think I have the collection of about 10 years budget which I post in Twitter before every budget, and see how was the budget and how was the movement. Similarly for election, we have the parliament election in 2024. Before last election also, from 2003 onward, 2003 or 2004 onwards, all the election, pre-election and pre-election, election and post-election movement I was tracking, and I was extrapolating during the election time, and I'll be doing the same this year also. So these news and event based trading is what gives me the better profit and the mileage during the other times. So it is very important. It is rewarding. People say don't trade on news. Market reacts and acts and reacts insane, and it is there is no pattern. But actually there is. Just that you need to categorize the news based on positive, negative, expected, unexpected, and headline news and detailed news. And based on that, if you keep on analyzing the market, after some time you will be able to decode and make bigger profit. Just one more thing that I need to remind you about the adjusted closing before moving into my trading setup or trading entry and exit. So adjusted closing, you might see that after 3 p.m. or after 3:15 p.m. option prices tend to trade way off compared to the futures or spot price. And most of you must be knowing the reason. 90% of you may be knowing the reason, but remaining 10% they might get trapped. So that is the reason I wanted to cover this slide, because the final adjusted closing will be the average of like last 30 minutes or weighted average of like last 30 minutes price movement. So this is the Nifty 3 minutes chart. Probably I'll take a day where the market was trending after 3 p.m. Okay, this day the market was heavily trending after 3 p.m. So 3 p.m. market was here. How much it was? It was 19,341, and I think I need to pick a day where the market was trending till 3:30. So those days will give even better clarity. Okay, I think this day can be the best. So this day 3 p.m. market was like 19,600, and by 3:30 the last tick was how much? It was 19,700. So the starting price was like 19,600 the low or open, and 19,700. So the market rallied 100 points. Nifty rallied 100 points. So when you are somewhere here 321 or 324 and all, when you see the market at somewhere close to 19,700, 19,650 calls will be trading maybe like few rupees, 2-3 rupees. You will see, okay, it is having an intrinsic value of like 50 rupees. Why is it trading at 2-3 rupees, right? If it is an expiry day. That is where the problem. So if you actually go into the daily chart, this is Thursday, June 27. So here, if you look at the actual closing, so the actual closing you can see here when I place the cursor, July 27 Thursday, 19,659.90. So I'll go to the 1 minute chart of July 27, and on the 1 minute chart of July 27 we will be able to see, this is the 1 minute chart. So here 3 p.m. So 3 p.m. it started here, and by 3:26, 3:25 now market was trading at 657, but the actual closing was like 359 somewhere here. That is the weighted average of this entire move. So when you see that towards the end of the second half, or towards the end of expiry day or any day, if the option prices are trading way off from the actual value, you need to consider that the actual closing is what to say, the actual closing is the weighted average of the last 30 minutes move. So previously, I think a couple of years back, I used to get arbitrage trade every expiry. So by the time when it comes in, the price will be probably very off, and probably the if the market is moving like this, the put options from here used to trade with higher prices, and I used to get a good trade during that time. But now I think there are many people, most people understood this, and they deployed the algos and other stuffs to mitigate the impact, and the price is very much settled with the expected closing by around 310, 315 onwards. So we don't get any trade, but when the price get adjusted, there are still chances that the people can get trapped there. The innocent people, or the people who doesn't know about it, they might get trapped. So just avoid it. So after 315, if you see any price anomaly and if you want to trade that, make sure that you consider the adjusted closing. So that is one thing. Okay, so next we will do something about what to say, my entry and exit. So entry, there is nothing much that I do. The entry, identify the direction and magnitude, then decide the strike price, trade type, and total risk you want to incur. This is most important, that the total risk you want to incur. That is what the most important fact here. Then start entering in small quantities and keep adding up to your desired quantity if the market gives better price, provided the reason for your entry is valid. So identify the direction and magnitude. Identify the direction based on the market analysis. I do whatever the chart patterns, or the positions, or the open interest, or the way the market has been moving. So based on those things, I identify the direction. It is identify the direction means it is calculating, or I form a view on the direction. It doesn't mean that it will be always correct. If my identification, or my estimate is wrong, my trade will be wrong. And the magnitude also, if I consider that the market is going to move big, I may go with option buy position. If I expect a bigger move or enormous move, I may go with the OTM option buy also. Or if I expect a smaller move, I may go with the option sell position. So depending on this judgment, I take the position. So if this judgment goes wrong, yes, my trades can go wrong. That possibility is always there. So just because that I mentioned here, identify the direction and magnitude, means I'm not anyone to correctly forecast the direction always, but more often than not, I get right, and when I go wrong, I book the profit. When I go wrong, I book the loss. That is the reason the total risk you want to incur is very, very important. So I decide how much risk I want to take in this position. In case my trade goes wrong, I will have to book loss and exit, right? So that is the reason I calculate the risk, and then start entering in small quantity. So while start entering in, when I have the clarity itself, I start entering in small quantities, maybe some of option sell price, or some sell traders or something. Then based on the chart, the retracement or consolidation and breakout or something, based on what happens on the chart, I may add more. Like if there is a breakdown and consolidation, and when the consolidation lasts maybe 30 to 45 minutes, maybe it is due for the next move, and when I see the start of the move, I might add into the position. Or sometimes when there is a retracement comes into the resistance level or something, I keep adding it. So that is how I increase the position, and that is the scaling in. And the most important thing is scaling out, not just the scaling in and the scaling out. So for the scaling out, for example, if I take a 3 minutes chart, I'll go to random this thing, and see, imagine if my view is along here, This day there is no exit, I think. But maybe this kind of day, probably imagine on the morning breakdown. So morning market was like chopping around, and from here the market is like testing the previous swing low, and probably somewhere here when it is approaching this level, I may start taking the short position. And when it is like moving like this and staying there, somewhere here I may add more, and it gives a one stretch of four. And probably on this candle, maybe maybe after this big red candle, uh, because when I get a big move in my favor, I try to most likely I tend to exit partially. Maybe I exit maybe 10-15 percentage or something of the total position. Then when it moves like this, and I may not do anything, and probably if it is coming to this level and sustaining, probably I will exit everything. But immediately after it is coming down, so probably somewhere here when I see the power of this red candle, I may add more. And again when it comes to continuous red candle here, and immediately when I see this candle, the longer wick, probably somewhere here or on these candles, I may exit some more. And when the market comes here, probably on this candle I may add little more onto the short position. But when it breaks here and comes somewhere here, I may exit everything, because it is clearing this high or even this high. It is not that great, so I may exit the position. And again, when the market is not sustaining this level on this candle, I may short again. So this is ideal situation, I said. Maybe that is how I plan to trade, and that is how I trade most of the time. But certain times I get stuck on my view and I trade differently and I make mistakes. So, but this is the ideal way my trading style is. So that is how I do the scaling in and scaling out both. So here, entry scaling in, not everything I enter in one stretch. I stagger it and take small position. And exit is very important. Scale out on the retracement, I keep exiting. And probably in one ideal move, if I tell you, probably this is a trending day, right? This kind of days, the ideal trade will be like if you're taking long on this consolidation. No, it's not a heavily trending day. Probably heavily uptrending day. If I look at somewhere, yeah, this kind of day, when if I'm taking a position somewhere here, probably maybe somewhere here on these retracements, most of the quantity may be exited. But this breakdown is not happening. It is not breaking down. See, this morning first swing low is never getting broken, so there is no proper complete exit here. And when it breaks out here and comes down, maybe in panic we might exit here, but otherwise there is no proper exit. If you discount these two candles, there is no proper exit. But this candle is little scary because there is a spike, then immediate sell off, so I might exit my position on the long position. Otherwise, if you discount or remove these two candles, there is no exit, like rally, consolidation, breakout, and rally again. So that is the proper trade. But on the each swing, each time when the market is moving, if it is continuous green candle, I don't do anything. Then the first red candle, I start exiting little bit, and maybe on the reversal green candle, I may little add back. So the scaling in and scaling out can reduce your risk to a great extent. You get better mileage for your remaining position, and when it comes down and if you're re-entering, you are eventually reducing the cost. Only when I have extreme conviction about a very strong trending day, I don't do any scale out. Otherwise, I keep on doing that. So in your trading or anyone's trading, the best part or the part which makes one profitable is exit. So mostly I will talk about that on the next slide. So how to hold the winning position is where I will explain the importance of holding the winning position and riding it. The next slide is how to hold the winning position, and that is what the most important thing, because most of the winning traders, the long-term winning traders, what happens to them is their success ratio may be like 40-50%, and 50 to 60% is like extremely high success ratio. But most people are trading with like 40 to 50 percent success ratio. The legendary traders, most of them having this kind of success ratio. Still, they are heavily profitable because they ride the winners long. So, if you ask me what is important, exit or entry? Uh, Ideally speaking, entry and exit both are important. Most people say we can't differentiate the importance of entry and exit, both are equally important. But I would say exit is most important than entry. If you ask a profitable trader, how do you become profitable? The most winning traders, they give one answer: cut your losses short and let your winners ride. So, cut your losses short means that is the exit, cutting the losses short, and let your winners ride, that is again regarding the exit, deciding how and where to exit. So most people, I heard, okay, I was into a position and that was in profit, and I entered in loss, and the loss is bigger, and when I get the profit I'm not able to ride, and that is the prime reason for people not being profitable for the long term. And if you look at my trade also, you can see that there are times when I get near 100% accuracy consistently for weeks or even months, but there are times when I get very weak accuracy, maybe like 30-40% accuracy for maybe for weeks or months. But even then, during those time also, I deploy only a percent of the capital, which is like very fixed amount, and when I lose only that much. But when I get a good winner even during that time, and certain times my trade goes into like 2x, 3x, or even 5x, or even 10x also. So if I get a 10x one trade, that can fund at least 10 trades for me, right? Wrong 10 wrong trades. So that is the importance of winning the or holding the winning position. I was just telling all these about the importance of riding the position. And you must be knowing the best trader ever in the history is Jesse Livermore, and I like him a lot. Although his ending or the final days were not that great, but the kind of trades that he was doing, that was extremely good. And what makes him different is the way he was riding the position. And he himself said, "It is not my thinking that made me rich; it was my sitting that made me rich." That means the sitting on the right position and ride it all along. And he says one more thing: the first eighth and the last eighth are the most difficult and stupidest thing to catch in the market. Meaning, you don't try to catch the bottom exactly, and you don't try to catch the top exactly. And he takes the position on the move up if it is a bullish position. When the market is moving down, he is not trying to take a position. When the market bottoms out and starts moving up, on the way up he takes the position, and he sits along until as long as the market moves up, and when the market starts coming down, on the way down he exit. That means on the move up he leaves the first stage and he'll not be able to catch it, and the market reaches the top. He's not trying to exit exactly at the top. He's okay. When the market starts coming down, he might lose some of the position or some of the profit that he had, and once he is convinced that the market is turning or taking a turn, that is the time he is exiting. So that is some context I wanted to talk about the holding of winning position. And here the scale in and scale out is one thing that we can practice to get the right exit, because I can't say where is the top and what is the exit. So what I do is I take a position. When the market gives each swing, I lighten up the position, which gives more mileage for the remaining position. But at least some portion of the position, when I have the conviction, I try to leave it until my conviction dies. So that is how I get the big winners. And one thing, always think twice before exiting the profitable trade completely. So why do I want to exit this trade now? Because you enter a position, it goes into profit, and you immediately get the hunch to exit the position. But think twice. Is the profit only reason for me to exit the position? If that is the case, no, that is not the right reason to exit the position, because you want to have your trade mature completely before exiting it than just exiting based on the profit. So if the answer of that question is only because of in profit, that is not the right decision, because profit is not the reason to exit the trade. I don't even look at the P&L. I just take the trade and exit. Only when I want to exit, I go to the position screen. Otherwise, I just hide it, and sometimes I even close the trading terminal. That's how I trade. And you go back to the when you have the hunch to exit the position, you go back to the reason for your entry and see if those reasons are still valid, and if the market is good and good to continue in your favorable direction. If that is the case, there is no exit there. But being an option trader, if you are in an option buy position, the premium erosion and a sudden reversal can literally deteriorate our position. So what I do is I exit partially and hold the remaining. And if you're still facing difficulty, reduce your position sizing. And when it comes to the final exit, at least if you're trading in 10 lot or even 100 lot, at least leave one lot of position until the trade matures without even looking at the P&L. And when you keep on doing that for a couple of times, eventually you will get confidence that you will be able to ride the position. So riding the position to the highest is the most important thing. But the problem is you should not be doing the monkey trades or pig trades where you do the entry and exit here and there. You need to have a proper view, proper understanding about the market, and clear conviction about why you are taking the trade and where the market is likely to head. You can't say for sure, but what is the probability? And when you think in probabilities, and if you see that okay, the higher probability is the market to go in your direction more and more, leaving the position open is the best thing. And in that case, if your psychology is not allowing you, reduce the position and keep at least a small position. And when you practice this, eventually maybe within few months, some people within few weeks, some people within few months or few years, down the line you'll be there. But just practice and understand this is what you need to do, and don't just exit the position only because of profit. Okay. And scalping. So scalping is a trading methodology which some people are doing successfully, and it is I know many people, or at least few people, who are doing it very successfully, and they consistently make profit, and they are winners. So I'm not saying that scalping is bad, but scalping is bad for the inexperienced people is what I say. Because when you do the scalping, it generally gives high success ratio, which attracts many traders into it. Like even if you don't know anything, if you simply take a trade, or even when the market moves quickly, when it gives a rally, buy some puts, or quickly gives a dip, buy some calls, and most likely it will show some profit, maybe 2-3 points profit, and you book it. That's a scalping. So that kind of trade, most of the time it gives you money. But the problem is when the trade fails, inexperienced people keep averaging, and they started losing a lot, and some of them even blow the accounts completely. And I'm sure that it happened to many of you, and it is a common phenomenon that I hear from most people. They say, okay, every day I can make few points, 10 point, 50 points, or I can make 10,000 bucks, 20,000 bucks. But when I go wrong, I don't cut it, and I make bigger loss. I need to control those days. Then I'll be successful. The fundamental problem is not just with that day. It is with the trading style. Because you take a trading style wherein you get small profit and bigger losses. And if you are doing the scalping, and if you want to make scalping as a career, you need to learn how to cut the losses short. That will even reduce your success ratio, but you need to do that. There are many people successfully doing the scalping, but the important thing that they do is they cut the losses also short. Not just the profit, even the loss, they book the profit very quickly, but even when it comes into the losses also, they book losses quickly and get out of the market. Only then you can succeed. If you book the profit in scalping and ride the losses, you will never become profitable. It is impossible. Okay, so it is not that I don't scalp. I do the scalping, but I don't use scalping as the only tool I use. But it is one of the tools. Certain times the market is not favorable for riding. Those times I do the scalping. It's not that I don't do it. And even option selling also has similar characteristics. When you make small profit, when you make profit, it is small profit, and when you lose, it will be bigger losses. So just make sure that even when you are doing the option selling, you cut the losses short. Otherwise, similar to scalping, you might lose big, and you might lose all the profit, even capital also, in few losing trades. Okay, that's all about the presentation mostly. And now to sum it up, I have two more things. One, it is about the books that help me to become a successful trader, or to, uh, what to say, to mold me as a trader. And second thing, to sum it up, I know I'll tell you to sum it up, tell you my trading mantra, which is weird for some people. So, identify the direction, know your risk, reward, and probability, then trade fearlessly within the risk tolerance. That's what I do. So some people, for identifying the direction and risk reward and probability, they use the technical analysis and technical tools. That is absolutely fine. I'm not saying that it is not. Even though I take a different approach, but using the technical tools for these things, it is okay. But even when you use the technical tools, trade fearlessly and trade within risk tolerance, that is most important. So when you take a trade, calculate the worst possible outcome. If that worst possible outcome is within your risk tolerance financially and psychologically, that is okay. You can take the trade and you can relax, because if the trade goes wrong, you know what is going to happen. And if the trade comes right, if you trail the stop loss, and if the trail the profit, you will be able to get a bigger reward than the potential losses. So the potential loss should be lesser than the potential profit. That is one thing. And so trade fearlessly, that is most important. But for trading fearlessly, you can't simply go and trade fearlessly. For trading fearlessly, you need to know the probability, you need to know the risk, you need to know the reward, and you need to know how much you are risking, and if that risk is within tolerance, and you need to know the direction, or at least estimate the direction. All of these are a part of trading fearlessly. So trading fearlessly is just one phrase, but behind that you need to consider all of these to become fearless trader. Okay, you must have seen that I take the trade and I simply sit there even when the market is moving around, and when the market moves completely against me, I exit regardless of anything. When the market moves in favor of me, I may get a greater profit. So sitting fearlessly on the trade is happening or possible only when you are clear about your risk, reward, and probability. Okay. And the final part, the books that help me, and this is not these are not the only books. I just shortlisted few books, and I think most recent couple of books I might not have added here, but again, I will explain about these book very quickly. Trading in the Zone, this is the one and only book that talks very detailed about your psychology, and I read and listened to this book multiple times to mold me as a trader, and it literally helped me. I would suggest read it at least like 5 6 times, just to make sure that you understand, and you teach yourself to think probabilistically. Very good book. And it is completely about trading psychology, nothing about the technicals, nothing about the market, absolutely nothing. It's only about you. And Market Wizard series, Jack D. Schwager, it is the interview with the world's prominent traders. Very good one, and you can understand how they do what they do, and what is in their mind, and how they manage risk, how they became a successful trader. It is good. It is story telling, and like a non-fiction book, you can keep like a fiction, you can uh, listen to the audio book, or you can read it. It is very interesting. It will not bore you, and it is interesting subject, trading, and really good. There are like 3 4 series: Market Wizard, Hedge Fund Market Wizards, new market wizards and unknown market wizard. So all are good. You can get to know about the prominent traders in the world also. And Marcel Link, High Probability Trade, and One Good Trade by Mike Belafort. These two books, they talk about the nuances of lot of tradings and intraday trading and other thing. Really good one. You can learn a lot of things about some of the strategies and some of the intraday trading styles and other thing. Good ones. And this is like Bible of technical analysis of the financial market by John J. Murphy. It covers every bit of technical analysis in detail. Very good one. I suggest you keep it as a handbook and use it use it as a study material, not just a book. Thinking Fast and Slow, to know more about your behavioral economics and your own psychology about thinking and taking decision, what impacts your decision making in financial world. He's a Nobel Prize winner, Daniel Kahneman, and it is amazing book. It is little tough book. It is very difficult to read and digest and all, but it can give or add a lot of values. It is not. I would suggest to read it only after reading other things, not a priority. And How I Made $2 million in the Stock Market, Nicola Darvas. It's a catchy title, but the book is very quality one. It is again more about how you compound the winning and how you ride the position and make bigger winning, or how to make bigger money with a smaller capital, and how the compounding works. And this book was written maybe at the age of like floor trading, not the online trading. So it was too old book, but still valid. All the principles and styles and strategies are still valid. Very good one. And What I Learned Losing $1 Million, Jim Paul. So what he says is there are like thousands of ways to make money in the market, but there are only few ways to lose money in the market. So he explains that. I agree with him, and it gives more insight to the way to lose the money in the market. And Reminiscence of a Stock Operator by Edwin Lefebvre. So that is the book about the Jesse Livermore. I think recently also I listened to that audiobook 3 times in the last 2-3 months or so. Every sentence in that book is a quote, and amazing. I don't have a word for it. Amazing book. It can literally tell you the things about stock operation and stock market trading and lot of things. Very good one. And The Psychology of Money, Morgan Housel. It's not about trading, but it's about money and money psychology. Good one. And Millionaire Fastlane, MJ DeMarco. Not about the trading, but about the business and about the way to success in the financial world and all. It is a different, what to say, completely different kind of book which can transform your way of thinking. Very good one. That one also I liked. And there is one more book that I suggest which is not included here. That is Bulls, Bears and Other Beasts. So that's about the Indian stock market, and that is a story by some Santosh. I forgot his full name. It's with Santosh. Starts with Santosh or something. And that's a real good book about the Indian stock market, the history of Indian stock market, right from the inception of I don't know, is it from the inception, but even Harshad Mehta time and all it is covering. It is very good. The bull and bear cycle, we can get a lot of insight. So these are the books that help me. Okay, so that's all about the presentation. And once again, I am telling you, my trading success mantra is identify the direction, know your risk, reward and probability, then trade fearlessly within the risk tolerance. And don't be so worried about being wrong in the market. If you are taking trading as a career, there will be losing trades. There will be series of losing trades. But in losing trades, try to reduce the losses. But when the winning trade comes in, don't just exit just because that's a profitable trade. You need to remember that your winning trades should offset the losing trades also. Like if there are like 2 losing trades and 2 winning trade, the net of the winning trades will be way higher than the losing trade. Only then you can offset the losses of the losing trade charges of the losing trade, charges of the winning trade, then the taxes, all that has to be offset by the winning trade. So don't just settle for any winner, you need to look for the big winner. And that is the most important thing, and you need to keep watching these stuffs to understand and get the conviction, the patterns and news and other things, or whatever we discussed, to see how these things are happening and how you can get the big winners. And I always keep these things in mind to form a market view. Where are the positions, where are the liquidity, all these. So that is how I keep a view in the mind, buy on dip or sell on rise. And one thing that we need to avoid is the monkey trade, or jumping around buying and selling here. And that is the reason I keep the position until I am sure that I am wrong. Even if it's a wrong trade, then I accept it. So what happens with many people is people are they just buy calls, lose money, then buy put, lose money, or all small losses only. But immediately the reverse position, losing there also. No, I don't do that. Don't do that jumping. Like bulls make money, bears make money, but what to say, pigs get slaughtered. That means the people who are juggling around, they get slaughtered, but bulls or bears, they make money. You form a clear view. In most of the days, I'm saying most of the days, not the extreme trending days, most of the days, if you have a buy on dip or sell on rise view, even though the major direction is wrong, you might make the money end of the day. That is how the market is. Let's say the market is like sideways to downtrend, but you are doing the buy on dip. You get a few good trades and a few bad trades, but net to net, if your winners are bigger, you may be profitable. So have a clear view and trade according to that, rather than completely switching unnecessarily. But if there is a proper change, you need to switch. That is also very important. Okay, so that's all about it, and probably couple of weeks down the line I may do one live Q&A also. And for now I am winding up the video here, and some of these topics like risk management and other stuffs, I may put a separate video also in future. And so wishing you all a trading career, and try to trade fearlessly within your risk tolerance. So thanks everyone.